Here is a fact that surprises almost every new business owner. Your single-member LLC does not file its own federal income tax return. You formed a legal entity, you got the paperwork, and yet as far as the IRS is concerned, your LLC's profits are simply your personal income. That confusion leads people to miss deductions, double-count income, or panic about returns that do not exist. In the next few minutes, I will walk through exactly how a single-member LLC is taxed, what forms you actually file, the self-employment tax nobody warns you about, and the deduction that can shelter up to a fifth of your profit. This is general education, not tax advice, so pair it with a real CPA. By default, the IRS treats a single-member LLC as what it calls a disregarded entity. That sounds insulting, but it just means the tax system looks straight through the LLC to you, the owner. Legally, the LLC is separate, and that separation is what protects your personal assets. For taxes, though, the business's income and expenses land directly on your personal return. No separate federal business return, no corporate tax rate, no double taxation. The LLC changes your legal life far more than it changes your federal tax life. In practice, you report business activity on Schedule C, which attaches to your regular Form 1040. Revenue goes on top, deductible business expenses come out, and the bottom line is your net profit. That profit is what gets taxed, not the total money that hit your bank account. This is why bookkeeping matters so much. Every legitimate expense you track, software, supplies, contract labor, advertising, reduces the taxable number. Misrecording expenses, and you literally pay tax on money you never kept. Now the part that stings. On top of regular income tax, your net profit is subject to self-employment tax of about 15.3%, covering Social Security and Medicare. At a job, your employer paid half of that for you. As a founder, you pay both halves, though you do get to deduct the employer half. This is the single biggest tax surprise for first-year founders, and it applies even if your income tax bill is small. It is also why setting aside 25 to 35% of profit and paying quarterly estimated taxes is standard practice. So how do you get paid? With a default single-member LLC, you simply transfer money from the business account to your personal account. That is called an owner's draw. Here is the key mental shift. The draw itself is not a deductible expense, and it is not what you are taxed on. You are taxed on the LLC's profit whether you withdraw it or leave it sitting in the business account. Draws move money, they do not change your tax bill. Here is some good news. The Qualified Business Income Deduction, often called QBI, lets many LLC owners deduct up to 20% of their qualified business profit on top of their normal expenses. If your business nets $100,000, that could mean roughly $20,000 the IRS never touches with income tax. There are income limits and special rules for certain service businesses, so the details matter. But for most new founders, this deduction applies automatically when their tax software or preparer handles the return. Just make sure it is not missed. 2 final layers. First, states play by their own rules. Some charge annual franchise taxes or LLC fees regardless of profit, California's $800 minimum being the famous example, and most states with income tax will want their share of your profit too. Second, your default status is not permanent. As profit grows, some owners elect S-corporation treatment to reduce self-employment tax, a topic with real trade-offs we cover in another video. The point today, know your default, because it is what you have until you actively change it. Let us bring it together. A single-member LLC is a disregarded entity. Profits flow to your personal return through Schedule C, and there is no separate federal business return. You pay income tax plus roughly 15.3% self-employment tax on net profit, whether or not you withdraw the money. Owner's draws are how you pay yourself. The QBI deduction can shelter up to 20% of qualified profit, and your state may want its own fees. Remember, this is education, not tax advice, so confirm your situation with a CPA. If this cleared the fog, subscribe to Founder Filing and check the description for free resources to keep your first tax season calm.